Today I'm going to show you a case study of my actual client and how I was able to make his life cover premiums much more affordable for the long term. Life cover is crucial to protecting your family's finances in terms of unexpected loss. But premiums have been spiking, putting policies out of reach of many South Africans. In fact, in the first 6 months of Sanlam's financial year 2023, they took a loss of 647 million, mainly due to weak persistency, and this is basically industry chat for policy lapses. So a lot of policy lapses have been happening in South Africa. In this video, I'm going to show you the various factors that drive up policy premiums, and I'm going to provide you with some expert strategies that I use, and you're going to see how I use them with my client to try and keep policy premiums down, and not just for now, but for the long term as well, because that's where the value in the policy lies, in the long term, not just now. So the goal here is to ensure that you get adequate risk cover from the most comprehensive product providers in the country at the most affordable cost. Essentially, we want to make life cover accessible and understandable to all South Africans. So if you know somebody who is in the market for life cover, who has life cover that needs a review and is just complaining about pricing, this is a video that you need to be sharing with them. And if it's the first time you have come across one of my videos, my name is Yolanda. I'm a wealth advisor, and it is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. So today, taking you behind the scenes into a client, we're going to look at some policy documentation, some products that we've provided, and how we able to meet the client's needs in terms of these unaffordable premiums that he's had. All right, so just some background on this client. Client is 50-something, is a male smoker, a couple of health issues. And ideally, when I get a client like this and, somebody who comes, especially in that age bracket, with the various health issues that come at that age, I don't want to be chopping and changing life cover or any kind of risk cover because it's just too pricey for the client. Okay. Essentially, the client watched 2 of my previous videos. One is life cover is scam and how to get affordable life cover in South Africa. I'm going to link up those 2 videos for you in the description. So after you're done with this video, you're going to watch those 2 videos and it'll give you a far better background into understanding this video here that you're watching. So he watched my videos and because he was just not happy with the pricing and the future pricing on his products, and he needed some help. First bit of help is I reviewed his documentation and I told him, you know what, you're going to go to your advisor, make this change, make this change, make this change, and you'll be able to keep this policy because it's been around for a while. You don't want to be chopping and changing at this age and with your ailments. That's the first solution. Go and do that. And if he can't help you, then I will help you. And unfortunately, the company could not help him. In fact, he did done all of that I requested him to do in the previous video. And he got no help from his advisor and his company. So he came over to me. So let's have a look at what he had and how we changed it. All right, so I'm going to show you the policy document now. I'm not going to name and shame companies here. Okay, that's not my thing because there's some great companies in South Africa meeting clients' needs differently. And I just don't want to diss anybody, okay, because there's some good companies. All right, so this is what the client had. He has 6 million Rand life cover and he had 250,000 Rand illness cover, an illness disability cover combined. And this is where he was at in the year 2023. He was 53 years old, and this was his premium that he was paying. Okay. And you can see where he started off. He started off at 3,500, okay, very affordable. But he very quickly escalated to 5,000 Rands a month. And if we go down, particularly when he retires, he's going to be paying about 20,000 Rand a month for this policy. Obviously, his cover amounts would increase accordingly, okay? But the client felt this was way too unaffordable for him. He needed to take some action now after watching my videos as to how he can put himself in a better position where he's not burdened by this during his retirement years because he is the breadwinner in his home. There's a lot, got his kids and other family members depending on him. He needed to make sure there's a financial legacy if he were no longer around. Okay, so it's imperative we get this cover in place, and particularly the life cover portion of 6 million. Okay, so let's talk about the reasons why this thing is so high. Firstly, the client was a smoker and he had some ailments, right? That increases your risk, and this is why it's important for you to take your cover when you're young and you're healthy, all right? Because that's when you're getting the best prices. The thing with risk and the management of risk is when you're high risk, it's hard to get cover. And if you're getting cover, you're paying very high premiums for it if you're lucky enough to get cover. and if you are high risk. So take it when you're young and you're healthy. All right. And in South Africa, if you're 20 something, you don't need large sums of cover like this. You start small. You put a protector plan on it where you can start unlocking it as and when you go through the various life cycles. Okay. This is not a big deal, especially if you're somebody in your 20s. Get life cover as soon as you can. All right. So his life cover was expensive because of his own personal risk. The cover amounts as well. He wanted the greater cover amounts. But the next thing here is this thing. This is the premium increase. This policy increases. It's the premium pattern at 7.5 plus an age-rated or age adjuster. Okay, that's the terminology used at this company. So that's basically age-rated. We broke down a lot of what age-rated means in our previous videos. Essentially, it means that as you get older, those increases get bigger, bigger, and bigger. All right, and we can see this here as he gets older. It's a big jump. All right, it's slowly increasing. It's not at a stagnant level. And that is increasing and compounding over time. So you can see here how the compounding works against you because of this age-rated factor. So my advice to him was to get out of this age-rated premium pattern and take something smaller that wouldn't impact these years more negatively, and the company wouldn't budge, the advisor wouldn't budge and couldn't provide assistance. Maybe it's the company's rules that they can't adjust all of this. And that is why picking the right company here is very important. You want to be with the right kind of company that gives you the kind of flexibility. All right, so the next thing that I could do to fix this client and make sure that he had affordable cover in his older years was to replace the cover. And replace it with something a lot more flexible, where he could change the premium patterns. So this is what I came up with. Okay, I gave him the 6 million life cover, 250 illness cover. And because we changed that premium pattern to a more structured premium pattern, and you can see here how the increases are, they're fairly fixed. Okay, but he went from paying 5,000 Rand some change to about 8,200 Rands. I know, big jump, massive jump, and extra 3,000 Rand more. But look at what the escalations are like. Okay, if we go back to the cover here, we see that in 10 years' time, okay, somewhere around here, when he's 65, he'd be paying about 19,000 Rands or so. Okay, here, he'd be paying about 16.5. So major difference here in terms of premiums. Essentially, it's the premium patterns that are working against you. Age-rated advisors use this a lot to make the a premium seem affordable for you upfront, but they make it in the back end. When you're older, you're more frail, you're more volatile, you're desperate for the cover, and you can't get out of it. That's where the premiums become so expensive for you guys, and you want to opt out of the cover, leaving you unprotected. Okay, so if you are in that situation, it's important for you to go back and understand what premium pattern you are in your current life cover. If you're expecting to take life cover, stay away from the age-rated factor, or at least be in something that's flexible, that will allow you to change the age rating and get out of that premium pattern when you get older. So if you have that flexibility, you can enjoy your younger years, your risk-free years with a lower premium. And then as the premium starts jumping, you can switch over to a more steady increase cover, and it's not volatile and fluctuating at horrible levels because of your age. Right, so this was the replacement. The client was happy to move over mainly because the product was a lot more flexible. All right, he could change the premium patterns. He was happy with his increases are lower. Okay, we could even have it at 0% as well. All right, he has that flexibility. If at year 10 he said, okay, let's cap it here at 12,700, we can do that. Right, the flexibility is there, and this is what the client valued higher than the premium. And a lot of the times, you know, we buy on price and not on value. And this is where the value comes in with that flexibility. Okay, client was happy, great. But essentially here now, as an advisor, I know this client is not adequately covered. This is the only cover he has. He has some group life cover as well. But essentially, there's some missing elements here in terms of his disability benefit. And this is how I made it better. Since the client was okay with this premium, I kept the premium the same, but I gave him a greater breadth of benefits, and that's what this looks like. Okay, I've given him income protection for 20,000 Rand a month. and extended income protection after 2 years for 20,000 Rand a month as well. So making sure that during his working years, because he has some ailments, if something happened to him medically that prevented him from working, he will still have income coming into the house, at least to cover the bills. All right, and he also had some work benefits as well. So we didn't need to really increase these premiums here because we took into consideration what he had available at work. Right, we gave him his 275, the one that he already had with his old policy. Okay, we've also given him critical illness income, which is really nice. He didn't have that in his policy previously, which is linked to his temporary income. We will give him 130% of that every month for 1 year if he had to make a critical illness claim. So that's almost doubling his critical illness benefits here. And then we gave him the 6 million that he wanted, keeping everything at that price range of 8,161. That's what he's paying. So you can see how we went from 5,000 inflexible policy into an 8,000 policy, far more comprehensive, but very flexible, and that is what the client valued. And that's what you should value as well as a client of insurance, that you have flexibility. And you don't want to be somebody who's forcing yourself into a policy and that's rigid and then you're stuck. Right? You want the policy to be flexible according to you, according to your life stages and what you want to achieve with your life cover. Right? So if we look at the premium projections here, on the ideal cover for the client, it started at 8.1. It's escalating up. And you can see those escalations are very much on the line of what he had in his original policy. And you can see what those annual increases are as well. But because we gave the client flexibility, all right, he was happy to move over because, one, the client's temporary income protection would fall away at age 65. So all of these premiums will fall away as well as the critical illness income. So at retirement age, he would be left with his original policy. Okay, and that would only cost him about 6,500 Rand, some change. The equivalent of 6,500, because all of this will be increasing. But what that flexibility allows this client to do is, at year 10, all right, if he says, okay, 18,500 Rand, that's enough for me, this is what I want to take into retirement, we'll bring these increases to 0%. Okay, the benefit increase will be 0. The premium increase will be maybe 4% or so. Okay, and it will be fixed that way. If he doesn't want 0 premium increases, we'll reevaluate the policy at that stage. The policy would increase slightly, okay, because having 0 escalations on the premiums is a more costlier approach to life cover, but essentially he has the flexibility to do it, okay, rather than being in the old policy where he's going to be struggling and he's most likely going to cancel. Here he can reduce his cover, he can reduce his premium, he can adjust his premium pattern flexible, and that's where the value of this policy lies. So if you want a similar sort of solution, click the link where you're watching the video. I'll be happy to sit with you, review your policy with you, and see how we can make sure that you're getting a policy that's really valuable, that's comprehensive, and that's flexible according to your needs. Okay, if you want to know more about life insurance and you want to understand more of the life insurance landscape in South Africa, click this link.